The Rebel Capitalist Show. I just got done re-listening to your last interview with our good buddy Eric Townsend. And so I want to kind of explore some of the ideas that you talked about there. The first thing that I'd like you to expand on is the Fed trying to ride two horses with one ass. Can you tell us what that means?
Yeah, they absolutely, it's in essence Triffin's dilemma. So they want to help stimulate the domestic economy as much as they can. And they also want to make sure the dollar doesn't fall chaotically.
Right.
And when the dollar was, back in March at 98, 99 and rising on the Dixie, and the economy was in dire need of stimulus, that was a really easy decision. Those two horses were riding in the same direction. You need to weaken the dollar. You need to stimulate. Great. That's easy. Let's do 625 billion a week in QE. Now that you got down to, when I did that interview with Eric, it would have been the Dixie was probably 89, 90 maybe. Now you're getting to technical levels below which you could set off a bit of a disorderly decline in the dollar. And once you get to a disorderly decline in the dollar, you start getting into a risk of touching off what I think is the Fed's worst nightmare, which is capital flight driven declines in asset prices in the United States. In other words, because the U.S.'s net international investment position is negative 60% of GDP, which is absolutely unprecedented in U.S. history, if the dollar gets too weak, foreigners that own all those assets will start. They repatriate their investment returns back to their own currencies, and so if they're making 10% in the S&P, but they're losing 12, 15, 20% in the dollar. I don't know what the right amount of disorderly decline in the dollar is, but there is a number in theory where that is true. Then you get into the Fed's worst nightmare where you get stocks down, dollar down, and there's only one way out for them, and that is to significantly raise interest rates, which of course isn't really going to help because the government's debt position is so big, they actually would make the situation worse. So once they get to a position where a chaotic or a disorderly decline in the dollar creates a vicious cycle downward in asset prices, they're really in trouble. And so I think that's really their worst nightmare. And so when we go back to March of 2020, it's really easy to supply lots of liquidity because the dollar down and the economy stimulate the economy. Those horses were riding in the same direction. With the Dixie at 88, 89, and the economy still needing lots of stimulus, given where unemployment is, given the rollover in tax receipts and some of the things we're seeing, those horses are now starting to ride in opposite directions. And so they're in a very difficult position. They're painted in a corner. And that's where that comment really comes from. Those are the two horses that are riding in two different directions now.
Talking about the disorderly decline in the dollar, is it the Fed's balance sheet that really matters right there, or is it the combination of the Fed's balance sheet and the government's balance sheet with the Fed monetizing the newly issued debt?
I think it's a combination of those two things, in addition to any number of other things, I suppose, as well. But what is, for purposes of what we're talking about here, it really comes down to what we've called: are they going to run the Soros Druckenmiller strong dollar playbook, or are they not? And what that is if in the Alchemy of Finance, George Soros refers to this currency theory. Druckenmiller referred to it again in Market Wizards by Jack Schwager. And the punchline is, if you increase fiscal stimulus but tighten monetary policy, you support your currency. You attract capital flows. So the Soros Druckenmiller strong dollar playbook, we saw that in the early 80s where we ran big deficits, but we also tightened monetary policy. Dollar went up strongly. Germans ran it in the late 80s. Same thing happened to the Deutschmark. The last time we did it was in 2Q18 in the U.S., and you saw increasing deficits due to the Trump tax cuts, monetary tightening by the Fed, dollar up, rates up, stocks up until something breaks. And so,
and did the stock market broke?
Yeah, and it was a stock market broke in 4Q18. That's exactly right. And so I think it's those two factors as we're talking about the dollar now. It's what's the government doing in stimulus and how much of that stimulus is the Fed buying, and just broken that down into enough and not enough. And in 2020, the Fed bought enough, dollar went down. In 2021, the plan at this point is for the Fed to not buy enough. It's a little bit black. It's a little bit gray, because then you get into, okay, what's the Fed doing? What's the banking system doing? What is the Treasury doing with the TGA, Treasury General Account rundowns? It's not as crystal clear as it was in 2020. But ultimately, that to me is really the deciding factors. Those are the two big levers in terms of what's the dollar going to do is what's the government doing with fiscal, and what's the Fed doing in terms of effectively monetizing that fiscal.
Yeah, so you don't think the Fed will buy as many bonds moving forward into 2021, or as many newly issued bonds. So I guess the question becomes, what happens to the long end of the curve? Is the market seeing that, or is the market that smart?
I think the market's seeing that a bit. I think it's part of a reflation narrative. I think there's this reflation narrative with the vaccines coming and getting rolled out. I think it's just the bounce back tied to that. But I think it's also partly this, where there is this Soros, Druckenmiller strong dollar playbook that is being run. The dollar's firmed up somewhat, and rates are backing up at the long end, and equities are rising. Asset prices are clearly rising, and so I think that's all part of what we're watching in real time. And the $64,000 question is when does something break, and what is it? What breaks? How quickly? And what will the Fed response be?
Okay, so Luke, when you're talking about something breaking, I'm assuming you're talking about because the 10-year, as an example, gets up to, let's say, 2%, and we see something like we saw in 2018, or we see economic indicators really start to turn down as a result of the interest rates in the real economy just getting more than the real economy can handle. Is that what you're referring to? Or is it maybe the government not being able to turn over their debt at lower interest rates? But I guess that would be the short end of the curve, wouldn't it?
Yeah, it'd be more at the short end for the government. They're really refinancing a lot of it there on an ongoing rolling basis. I think, to the prior point of your question, I think that's really where we'll see the biggest problem ultimately. Or I guess, let me put it this way: that would be prime suspect number one, is that the long end will get too high, and we'll see some sort of sharp slowdown, probably overseas, probably in emerging markets, where you'll see the first problems. And so I've been watching some of the more sensitive emerging markets there. When you look at things like Argentina or some of these, the weakest emerging markets historically on a current account basis, current account balance basis. So that's probably where you'll see it first. Right now, it doesn't look to be a problem anywhere, really. When you're seeing energy prices are rising, you're seeing home prices rising, you're seeing everything rise. So I'm open to the possibility that it could be a problem somewhere else. It could be even 2 weeks ago with GameStop, where we had this sort of short squeeze, and authorities had to regulators had to kind of step in and sort of adjust the machinery, I guess, if you will. But we had 2 days out of 3 where the Dow was down 600 plus points. So I'm open to the concept that because we're so far down this rabbit hole, that it could look a little different than it did in 2018 in terms of the long end of the curve rising as being the trigger per se.
How does the long end of the curve affect emerging markets?
Just, I think, in terms of the dollar strength, ultimately, this whole dynamic, it's not just that, but ultimately it's really, to the extent this Soros, Druckenmiller strong dollar playbook works, you're taking away dollar capital away from elsewhere. And as that happens, the issue isn't that they're short dollars. They have plenty of dollars. They're net long dollars, really, when you look at their the U.S.'s net international investment position that's negative 60% of GDP. Or more. If you net that against their debt, their dollar debt, they're net long dollars effectively. But they need to sell those assets to get those dollars. And if they sell those assets to get those dollars, they crash our markets, and our economy doesn't work unless stock markets are rising. So it sets off sort of I won't say a death spiral, but a vicious cycle in the wrong direction, where asset prices down, consumption down, GDP down, tax receipts down, deficits up. We need to issue more debt, and it gets into this problem. So that's really where I think it reflects in the on the emerging market side.
So the Fed's maybe just hoping for this Goldilocks scenario where the long end of the curve just gradually goes up, but it doesn't, to your point, doesn't make anything break. The stock market doesn't crash. The housing market doesn't crash. We don't see emerging markets blow up if we see the dollar spike, and they can just kind of ride this just bits and pieces of stimulus just to keep the economy, I guess we'll call it functioning in quotes, and then just have the dollar dropping and just keep going back and forth and back and forth. What's the end game there, though? I mean, what are they hoping for? Is that the Hail Mary? Just they're hoping for aliens to come down and help us out with free energy? I mean, what's, or are they just kicking the can down the road and just saying we'll worry about it later?
I think it's some combination of the Hail Mary and kicking the can down the road. I mean, ultimately, they're acutely aware of the issues. And you know that because of what people like Alan Greenspan, Larry Lindsay, Richard Fisher, Stan Fisher, Yellen, all these people, they get out of office and they get very honest. They understand the problem. But when they're in office, they are as much politicians as they are economists and central bankers. And so they really can't tell you the truth because they're in a political seat. And so they need a massive spike in productivity to get out of the entitlement problem, barring some sort of free energy, nuclear fusion, rapidly created, distributed, et cetera. That's an issue,
especially with lockdowns and COVID.
Especially with lockdowns and COVID, that's very difficult to get. And so, well, I think it really is just trying to sort of kick the can along, and hopefully, string it along as long as they can.